Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your host for The Mortgage Voice here on many radio stations in California now, and certainly out in our new affiliate out in Las Vegas, Nevada. I wanted to say hi to everybody, and thanks very much for tuning in each and every week. Check out our Mortgage Voice podcast on the Apple Podcast, Google Music Play, and wherever fine podcasts are heard. Subscribe for free and never miss an episode. And please leave us a review. It really helps other people find the show. We're also on YouTube, Jeff Barton at The Mortgage Voice. Our subscription to that particular channel is growing, and I really appreciate it. I know that if you go to YouTube and look up mortgages or mortgage talk shows or however you say it, there's not a lot of us out there. I mean, in reality, this is a very narrow subject in a very wide field. We think it's important that you have the best and greatest understanding of what goes on in the mortgage process, especially with what's going on today. So we do thank you very much for listening. If, again, you want to see us directly, go to www.themortgagevoice.com. Again, I'm Jeff Barton, and thanks for tuning into the show. We have some interesting details going on with the coronavirus, and I wanted to talk about it, not necessarily about the virus itself, but about how it affects you and your loan. What is happening to many businesses around, mine too, the business that I work for, Malibu Funding, who sponsors the show, and I appreciate what they do. So that company, my company, the company that I work for, has gone to a flex schedule. And what does that mean? It means that you come in one day, I come in the next day. It's a rotational based, really bare bones staffing that allows the company to remain open, continue to service its clients, certainly the borrowers, and to make sure that the people who work for the company get paid. I think many people are awaiting that federal individual bailout that they've talked about, i.e. I'm going to mail you a check. I don't know if that's really going to happen or if it's not going to happen, but they seem to think that that is a way by which people can get paid on a daily basis who are used to getting paid bi-weekly, every other month, whatever it is, and that helps pay their bills. But for you out there who are listening to the show and have loans pending, i.e. you're in a property contract here in Vegas and you want to know what the status is of your loan. I know there are several refinances that have taken a back seat to purchases, as they always do at the end of the month, and they always do in a time crunch. Today, what we're seeing, obviously, is because of the pared down staffs, and I just spoke of Malibu Funding, it's like that with any business that has more than 4 or 5 people that are in a room together. They are now having that workload, trying to push people off to their houses to be able to work from home. It's somewhat doable in the mortgage industry, but it does mean that there may be delays. I know there are 2 refinances I'm waiting for right now. They're in line for docs, clear to close, and we are still waiting. Now, the reason for that is obvious. There aren't enough staff to handle what's been going on. And conversely, let's talk about the rates. In this environment, what we have seen and what we spoke about last week was a historic lowering of the mortgage interest rates. We were talking at 2.75 a week ago. A week later, what are we talking about? Well, usually what drives the mortgage interest rates, everybody on my show knows, it's the bond market, the 10-year bond market. And if Matthew Graham from Mortgage News Daily is often emphatic about saying is, when the Fed lowers your interest rate, does your mortgage rate get lowered or the rate that you're going to be charged for your mortgage? The answer is no, and he said it in all caps. I won't shout it out, but that's what he was saying, and he's absolutely correct. This environment last week, let's go back a week, prior to the really stunning developments in the progress of the coronavirus and how it's affected daily lives of people. So last week, the mortgage interest rate at 2.75. We were trading the mortgage-backed securities, the 10-year note. That's what affects the real estate mortgage interest rates. It fell down to about 0.34. No, we were not negative. But as a comparison, 2 months ago, we were at, over 2%. So now that we're down to 0.34%, what happened to the interest rates? You would think, as everyone who listens to the show, there's a corresponding relation between what happens to the 10-year note and what happens to mortgage interest rates. Well, the exact opposite happened. So the question is, why did the exact opposite happen? And I think it's an artificial pushing of the rates to slow down the refi market. That's what I think. So if you had locked in last week after the show or during any time last week, it was a good thing because you got the best interest rate that's been out there ever. This week, although the mortgage interest rates aren't bad, they aren't what they were last week. They're a point higher than they were last week, 3.75. Some interest rates are even up at 4%. So the lenders, regardless of the mortgage-backed securities, not mortgage-backed securities, the 10-year Treasury notes, trading, actually today, I think they were trading at, what were they? 0.84%. So it's up a half a point since last week. Still, historic lows in terms of the yield. Now, when you buy these bonds, the yield that it gives you drives the mortgage interest rate. So the lower the yield, the lower the interest rate. That's usually how it works. In this case, it did not work that way. So if you're one of these people that's scratching your head going, well, Jeff told me XYZ and it's not happening. Well, I'm sorry. I don't know why, other than to say that the industry itself has been inundated with mortgage applications. I said there was 11.1 million people who could benefit with the lower interest rates. I guess they all decided to show up and refi over the last 2 weeks because the banks have slowed the process by upping the interest rates. So what we're going to see probably over the next 90 days is an up and down of the interest rates, meaning that 1 week it'll be like it was last week at 2.75, and the next week it's 3.75, maybe 4%. Now that's controlling the marketplace in order that you don't burn out your staff, which I've already mentioned is halved because that's the way they're dealing with the coronavirus. So if you're, and all this is a long-winded explanation, I'm sorry, as to why you may have a delay if you're purchasing right now, and to not freak out. Most people in the real estate industry understand this, but some realtors, some brokers, some people who are not as sophisticated will not understand this. So if you're a buyer and you're waiting for your mortgage and you're getting pressure from the listing agent to produce or lose the deposit, refer them to the show, because this is a basic countrywide place where we're all in terms of the mortgage rates, the way that the mortgage rates are up and down, and the having of the staff, and the amount of applications that are in. All of these things are slowing the entire process down. As I said, I'm waiting for 2 refis. We are clear to close. We're trying to get docs out. And why? Because they are just slowing down the process. Now, some of this is the availability of money, right? Well, we just heard from the Fed, and I think Steve Mnuchin, who, if that's the correct pronunciation for the poor guy's name, he talked about what we're doing at the Treasury and and obviously Jerome Powell at the Fed is talking about what they're going to do to maintain liquidity in the markets. One of the things to do is to buy mortgage-backed securities. We all remember quantitative easing. Now, that's a fancy term, again, for the Fed or the Treasury buying mortgage-backed securities or buying treasuries themselves, treasury bonds, and that artificially kept interest rates where they were for many, many years. It ended a year and a half ago, picked up slightly last September, and now we're full into $200 billion to $300 billion of mortgage-backed securities purchased monthly. That's full-on QE4, folks. That's where we are, and I think As a result of that, we're going to see pretty good interest rates for the rest of this year, especially through the election. And so if you have a purchase pending, you're going to be patient, but you are going to be able to get pretty solid rates for the remainder of the year, in my opinion. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and thank you for listening. This is The Mortgage Voice, and check us out on Mortgage Voice Podcast on Apple Podcasts, Google Music Play, wherever fine podcasts are heard. Subscribe for free, never miss an episode. Please leave us a review. It helps a lot of people find where we are and what we do. It's a niche kind of thing, but for those of you who are looking around for a house, who want to do a refi, we are the most important thing you're going to listen to today. We're also on YouTube, Jeff Barton, The Mortgage Voice. Subscribe to the channel. Click on the bell to get notified wherever and whenever a new episode is available, and you will be notified. We have a website too, www.mortgagevoice.com. And again, thanks for listening. I'm Jeff Barton. We're on several radio stations in Southern California, in the Inland Empire. I want to say hi to those fine folks. And also up in the Tahoe area, high up there. Also our new affiliate out in Las Vegas, Nevada. So with us once again is a great voice of reason in this sea of craziness that is the coronavirus, and also the low interest rate environment, is Luke Mankey from Malibu Funding. Luke, how are you?
I'm good, Jeff. How are you doing?
You know, I'm okay, although every day is a little bit of a push and pull. If I listen to the news too much, I don't want to leave the house. But if I don't, and I get out there and just be careful, I can have a pretty good day. How about you?
Yeah. It's we're spoiled with this perfect weather normally, 300 however many days a year, and having all this kind of global pandemic coupled with torrential downpours and windy days is making it a little bit more extra depressing for us spoiled Southern Californian people. But it's we're doing as best as we can here.
Okay, the focus of today's show and what I wanted to talk to you about. Okay, so I'm in a purchase and I am now in the middle of a pandemic. What should I be feeling, and what can I expect from the mortgage industry?
Well, it's still, this is not, nobody knows for sure, of course, if we're going to enter into a recession. I don't think so. This is obviously not a credit crisis, was one of the major contributors to '08.
Yep.
Every day changes, of course, but you would like to think that if we can flatten this curve and things improve in the next month or two, which everybody is hoping and thinking will happen, then there's going to be a tailwind that we're going to get into, I would say, and call it fourth quarter of this year at the latest. I just got to think that everything's going to recover and kind of pick back up because the economy was strong. Like, it's doing fine. Like, yes, right now there's a panic, but I just feel like if I was in escrow and I'm supposed to be closing, I'm still going to close. Rates are still low. Of course, assuming they can still afford it, I don't know if I would want to proceed if, I had the next 2 or 3 months being off work and wasn't going to earn a paycheck, then maybe that could pose a little bit of, give me pause and concern. But for anyone else that, has stability with employment, I would proceed with it.
I'm going to ask Wendy when she comes on the show from Stearns, exactly how are the lenders going to deal with underwriting standards when they may have a gap here of a couple, 3 months of employment, especially for someone that was no fault of their own. Can't really call it a layoff. What do you call it?
Yeah. It's funny you say that, and I should have asked. I meant to today, and if I wasn't as busy as I was, I would have reached out, because I had a discussion with one of our clients that I've done many loans for, and she's getting paid through the end of this month, of March, and then after that, it's nothing until they can come back to work, which could be weeks, could be months.
Yep.
Who knows? And you're right. That's the question for Wendy and some of these other. I didn't ask today. I wish I would have for the show, but that's a good one for her to answer and clarify how they're going to handle it. It's an important thing because, yes, it's going to affect not just a few people. It could affect a lot of people, especially if this goes on into the summer.
Yeah, think about that for a second. So we've heard, and I don't know, I was talking to my wife about it. just the economic significance of staying home for 2 weeks and not getting paid, just in general. You've got a mortgage, you've got credit cards, you've got car payment, just the general bills. Okay, so maybe you can hunker it down for 2 weeks. But what happens to your credit? What happens if you miss a payment on your mortgage, again, to your credit? What happens to all of these things that are really built on timely paying of your bills on a month to month to month? I mean, that's how everything in our system of credit is built. What if an interruption like that? How would you say that you could advise, I guess, a client if this is happening to them? I know you said that you had a discussion, but what's your thought on that?
Yeah, and there's a question. I don't know. Very great question, and I don't know if any of us really know. Like, maybe there's going to be a level of forgiveness where, just like what they just said, I think today about not going to require everyone to pay their tax bill. There's going to be basically a forgiveness period of however long to pay your taxes. You don't have to file them and pay them by April 15th. Maybe there will be something like this as well, where they're not going to report late on credit cards or mortgages if people can prove and document that they're in a financial hardship, and maybe they can't approve it. So we don't know. That's not out there. It hasn't been offered yet, but it's a fair question. If this goes on long enough, I got to think if they're going to be giving money to people that are at need through the government to help them put food on the table and pay bills, then maybe there's going to be a forgiveness period we don't know about. But, I mean, self-employed people, it's going to be easy. We can close, even if we're in this 2, 3, 4 months long hiatus. Self-employed people, first of all, they're probably still going to be working in some capacity.
Right.
And we can still verify employment through a CP letter, and so I don't think there's going to be much interruption at all with them. I think the question is, and like, my wife is salaried. She's not going to have an interruption in work and pay, so she's fine. I just think it's those salaried buyers and borrowers that their employers are basically forcing them to stop working or work from home, but then they're going to stop paying them. And those are the ones that, gosh, I don't know, with the inability to potentially pay a mortgage or a credit card or whatever. Like, I don't really know how I would advise them. I would tend to think that hopefully within the next few days or a week, maybe there'll be a little bit more clarity on that. But
I heard a guy.
What a fluid process.
I heard a guy yesterday on the radio. I forget what show I was listening to, but he was bemoaning the fact that he was a 1099 independent contractor and was not being able to apply for unemployment insurance since his business just dried up as a result. Now, correct me if I'm wrong. If someone is a borrower who gets his money as an independent contractor, in those payments that the companies make to the independent contract, aren't those payments, once you receive them as the independent contractor, aren't you supposed to pay into all those systems? I always thought you were. Is that not true?
I'm not 100% sure myself either.
Aren't you supposed to pay into unemployment insurance and workers' comp? And isn't that part of your responsibility of paying your taxes? I always thought it was. It may not be, but I always thought you were supposed to pay like you pay income tax.
Yeah. Gosh, I don't know for sure, and so I don't want to say with certainty, but it makes sense that you would. And then, you would think that person would be protected by it. But boy, you got me. That's a good question.
Right. Well, I think what happens, and again, if the government is lining up to give people checks, there's the abuse going to happen out there. You just know it.
Oh, yeah.
If they're going to give loans to, I heard this too, small businesses and I don't know how you document it, and who do you document it to, that you've lost money or that who are you going to send it to? There's no mechanism for this to happen. You're just going to apply through what, the SBA but it's so rife for just dishonesty and, anytime the government is going to get involved. But I just don't know our way out of it if, in fact, obviously people are hurting, but people are also going to abuse it.
Yeah. It's just going to create, and I can see the writing on the wall, it's going to create that much more work for us. It's just like, when people were doing loan mods, and then we had to document, like, was it distress? Were there extenuating circumstances that we can then not have as stringent guidelines on them trying to qualify now when they had these loans. This was, of course, back more like 2015, 16, 17. But Yeah, I could see that. Like, we're going to get these ratings that show late because the credit companies are going to report naturally. That's what they do. But
Right.
then if we can document that they had this assistance, then I'm sure we'll be able to omit it. But, boy, it's just, we're already busy enough as it is, and I can just see this adding that much more of a layer. It's just one more thing of the 83 different things you got to have bouncing around in your head when you're looking out for certain landmines to help navigate people around. But, I mean, yeah, it'll be good for most, but you're right. It's totally going to create additional kind of confusion and people abusing the system and all of that. But
Luke, shout out your phone number for somebody who wants to guide a good steady hand to guide them through this mess.
Thanks, Jeff.
Sure.
Phone number is 818-209-2592.
Great. Thanks, Luke, for coming on. I really appreciate it. I always go to you for somebody who can try to help me walk through this. It's very confusing, and we're trying to bring some semblance of order to it. Thanks again for coming on the show.
I appreciate it. Thanks for having me.
Thank you, too. That's Luke Mankey from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. Hey, check out the Mortgage Voice podcast. We're on Apple Podcasts, Google Music Play. We're all over the podcast world. So wherever fine podcasts are, you can listen to us. Subscribe for free. Never miss an episode. Leave us a review. Helps other people find us. Also, we're on YouTube. Jeff Barton, the Mortgage Voice. That's our channel. And if you click on the bell to get notified, a new episode will appear every time you do that. So if you click on join, we will get in touch with you ASAP when we have a new show. Check us out on our website, www.themortgagevoice.com. And how was that, Daryl? Is that good?
Every time a bell rings.
I don't know. I screw that up every time.
If we're doing Christmas stuff, an angel gets his wings.
This suit needs her petals. Yes, I know. Okay, with us again, and not to make light of it, but we have a very serious event going on in the lending industry as well as the rest of the country economically. One of the people that we go to for answers is Wendy Van Wessel from Stearns Lending, and she's kind enough to join us again. Wendy, how are you?
I'm just fine, Jeff. Thank you very much for asking me back.
Okay, thank you. All right. First off, how are you? How's everybody? You're all healthy and good?
Yes, you just have to be smart. Yeah, you just have to be smart about what you do and don't touch your eyes and your nose and don't go to big public places, but I think that we'll all be just fine.
Okay, now, at Malibu, we've instituted some procedures for the company, for the people that come there, in order to limit exposure from each of us to each of us. How are you all dealing with that over at Stearns?
We've had a lot of remote underwriters and a lot of remote people. So we've started that process a while ago, realizing that was a viable, in our technology age, that we could do that and still offer the right kind of service to our borrowers and our brokers.
Okay, we did that too, and part of what makes Malibu a little bit different is that we don't have 50 people sitting in a room making calls to try to get loans. Most of our loan officers, all of our loan officers, work remotely, either from their home or from their office away from our office. So that part's not a big deal. In terms of the central core of people that work for us, yes, we do flex schedules, and we're just rotating days we're coming in, so that really helps. But given that, I had some questions about funds available during this crisis, funds available for loans. How is that proceeding, and is there any hiccup or any issues with that with you guys?
Well, the market's gone crazy, and I think a lot of the brokers are getting calls from their borrowers.
Right.
And they're saying, hey, I heard you can get a 0% interest rate. Well, that doesn't happen in the real world. Even though the Treasury is down, the lowest that it's ever been, those are longer-term bonds. Those shorter-term bonds, the mortgage-backed security bonds, aren't following suit. For the first time in a long time, they split. Mm-hmm. So, yes, the rates are at historic low. No, you can't get a 0% interest rate. Sorry, it doesn't work that way.
No.
We wish it did, kind of, maybe.
Oh, the rates went up this week compared to what they were last week. So that's a whole different ball of wax.
Monday was the lowest, and the highest jump in rates was from Monday to Friday because the market's been all over the place. No one knows what to expect.
Mm-hmm.
I think that what you're to your point, I think that a lot of the smaller lenders out there might have a hard time with how much volume they get and whether they have enough funds or not.
Right.
In that respect, I think Stearns, who's been around for 30 years, and I've been with them for 10 years, has Blackstone backing them. Blackstone has a lot of money. We're not worried about whether or not we have enough money to fund your refinances or your purchases. As a matter of fact, for purchases, we're doing 0.50 more in basis points as a special because we believe in the purchase market's going to be just fine. You can send out broker and borrower disclosures. You have e-signatures. It's that notary that's going to come out to your house, that one person, or meet somewhere that might be a little harder or longer to get, but we have a 60-day pricing for the same price as 30-day locks. So we're anticipating some of that stuff and making it easier for your loan officers and then their borrowers.
Let me ask you a question on underwriting because we had a question come up and I talked to a loan officer earlier on the show about it. Let's say that you have a job and you've been just told to go home and stay home. You get paid for a couple of weeks, but after that, you're not going to get paid. How is the underwriting standard going to look at that if it's obviously not a layoff, or is it a layoff? Does it count against the borrower because there's a gap in income? Have there been any solutions offered up from Stearns as to, because this is going to happen?
This is a moving picture, and
right.
I would say that I would call it one of two things. It's either going to be temporary leave, like when you're pregnant or when you have a temporary leave, and as long as you're back by the time the first payment is due, which you skip a month, so you have like 60 days, right?
Mm-hmm.
Not quite 60 days, but a length of time. Then that would be temporary leave, and if you have a written VOE that you're likely to continue, and this is your hourly wage, or this is what you make, then it would just be business as normal that way. Or, like when we had all of those fires, we had a special program that was put together because of the fires out here in California that said you don't have to pay your old mortgage if your house burnt down. You don't have to give us any of your tax documents because they might have been in the house that burnt down as well. So they made exceptions for the stresses or catastrophe or whatever you want to call it that happened in the borrower's world. So they're not immune to that. They do make concessions, yes.
Okay, so I guess what I'm thinking about is you have a worker who has been working, making pretty good money, and a combined income, two-person household. One of the incomes gets, kiboshed midway through a purchase because of this issue of not getting paid during the coronavirus because the company that was paying you is basically cutting staff until the coronavirus crisis is gone and the economy gets back to normal. That gap in income that those people have not only is going to hurt the obvious need for proof of the ability to repay the loan, but it's also going to hurt the credit score. So this borrower is through no fault of their own, through no fault of the economy, really. These extraordinary circumstances, I just don't know how lending, how lenders, how underwriting standards, how all of that. You addressed some of it, but what are your thoughts on that as well?
I think that every loan is different. I think that every person's situation is different. If we have 2 years of making this kind of money with 10 years job history, and that you can see that they're making payments on time and they have decent FICO scores before this event happened, then you would look at that and you would look at the borrower's ability to pay on their mortgage, to pay on that collateral. That's what we're looking for as lenders. Is it a safe bet that these people are going to make sure to make their payments? Yeah, they've been 10 years in the same job. They've had never any late payments on there. They have a 710, 720 FICO score. Those people are going to be looked at, and I'm sure that just like the paychecks are going to have less taxes taken out, that we will move to make this thing work and not be sedentary, because it doesn't help anybody for that.
So you're talking, Wendy, you're talking more manual underwriting here rather than your automated underwriting systems.
Correct. As long as Fannie and Freddie will purchase the loans, or Ginnie Mae, or pool and sell, the investors will buy them because they can see that the borrower has strength and thinks it's important to make their payments on time and is a good risk. And then I think that it will be business as usual with a little bit of extra proof, written verification from the employers that their business is likely to continue, that they're not, because of the coronavirus, going to go upside down. But always a different picture, and I think we have to look at them more on a one-on-one basis. But overall, if you can get back to work within a month of not receiving any income and have that same income, then that would be called temporary leave. That's one of them that's already in place, and the others I think will come.
Okay. Let's say the government starts sending people checks. How is that income going to be looked at? Is that just sort of free money? That obviously the checks are going to be a certain size, and the certain size means that that money will be spent. I mean, that's the purpose of why back in the Bush administration they sent checks at that time, because they wanted the economy to get a jump start. And I think there was generally most people, I think it was $800 to $1,000 that they got. They spent it immediately. But this thing could go on for several months. So getting this kind of...
Only my opinion, and nobody really knows for sure.
Right.
I think it'll die down in the summer and come back next fall. So you have to be careful again, but hopefully they'll have some kind of vaccine by then.
Yeah.
And it always dies down in the summer. So I think we're looking June, July-ish maybe, right? It's that long, and I hope it's not that long. We just have to be careful. You got to be smart out there.
Well, there's no question about it. I'm just on a financial end trying to look at it in terms of that person who's trying to get their first home or trying to buy up.
It would be like disability. It would be like disability as far as that goes. I think that you would need to have, I mean, we even do loans with offer letters. As long as they start 90 days out from when they close the loan, we have offer letters for future income.
I see.
So there are ways around it. There are ways of looking at it. I'm just not sure. I wish I had that crystal ball.
Me too. And you were my go-to. So and I understand that this is a situation that is changing every day, and we're not quite sure where it's going to land. But making sure we have the processes in place. Wendy, thanks for coming on the show. I do appreciate it. Always, you're always a wisdom that I don't get from a lot of people, so I appreciate it.
My pleasure. Thank you very much.
Thank you very much. That's Wendy Van Wessel from Stearns Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening. Check out our Mortgage Voice podcast on Apple Podcasts, Google Music Play, wherever fine podcasts are heard. Subscribe for free, never miss an episode, and leave us a review. Helps other people find us, and we need to be found. The information that we have for you today is excellent, and it's really dependent on what's happening in the markets as well as what's happening with the coronavirus. We're also on YouTube. Click on Jeff Barton, The Mortgage Voice. That's our YouTube channel. And there is a bell there, so click on the bell. Get notified whenever a new episode is available, and it is available each and every week we do this show. We have a bunch of other shows that are on the docket once the coronavirus scare gets gone, maybe in July, they're saying now. But check us out at our website as well, www.themortgagevoice.com. I'm Jeff Barton as again. Thank you very much. I want to say hi to our affiliates around Southern California and up in Nevada. Hi, everybody. I really appreciate the listeners and the people who listen each and every week, and the fine people who bring those shows to you. With us is George Gonzalez, who is a loan officer for Malibu Funding, one of the top producers and somebody who really has been around the block a few times since 2008 when we went through that, George, right? Now we're going through this. What do you think is similar? What's a little bit different?
Well, yeah, Jeff, thanks for having me on today.
Sure.
I'm just going to share a little bit of this madness that's going on around over here in the Inland Empire with this coronavirus and mortgages.
Yep.
Yeah, you are right. The 10-year bond is actually even lower than it was in 2008. So it seems like it should be worse. This financial crisis seems like it should be worse.
Right.
It's actually worse for the banks and better for the public. However, we're seeing a few things a little bit different on end, which is kind of weird, where I had to, make a few phone calls and to a little bit of hire people who knew a little more, like owners of the banks that we work with, just to get some insight, like, hey, wait a minute, the media is telling the public the interest rates are at near 0% and low, and the Fed's cut the rate, which they did, and they're making the public believe
that means that their mortgage interest rate could be 0% or 8%, whatever it might be.
Yeah.
So, I'm getting text after text and email after email and phone call after phone call, and I'm saying, wow, that's news to me. So I go price it out. I'm looking, and the rates are actually getting worse for the consumer.
Right, they're going up. Right, I agree. It's just insanity.
So
I know.
Like, what the heck is going on? And these people are thinking I'm lying. Well, I heard different, George. You heard different. Well, I'm asking them, well, who did you hear from? Because I want to work with them.
Exactly. I'll go. That's true. That's exactly right.
So, these people, and then finally, you have to explain to them, like, hey, the feds cut the rates for the banks, so it's cheaper for them to loan the money.
Right.
And, of course, the banks still need to make a profit. And so, they're not going to go to zero like they're getting the money for. They're going to be making a profit. Now, when I asked how come they didn't lower them just a little bit more than, because the rates have already been low, as you know.
Yep, they have been low. You can't get much lower.
Extremely low.
Yep.
Doing real well with some streamlined refis and stuff like that. But when I asked them, I called one of the banks we work with, and talked to the manager and one of the higher reps, and they were telling me it's simple, George. They said, we can't handle the capacity.
That's right.
And when we can't handle the capacity, the only way to resolve it is to raise the prices and raise the rates. This way it slows down the incoming loans that are coming in, so we can catch up and keep up.
Mm-hmm.
So he had told me, George, we were going from, let's say, for an example, 35 loans a day coming in to all of a sudden 350 loans coming in.
Right. Right.
We don't have the manpower to cover it, so we're not going to tell you guys that. We're just going to raise the price and make you stop sending us bills instead of telling you we're not taking any more.
This used to be the way it was priced. I'm trying to think what year was it, 04, 05, 06, maybe like that, when that's what would happen all the time. And you basically had the loan officer having to go from bank to bank to bank, or mortgage lender to mortgage lender to mortgage lender, to find the best rate, or the bank that was the slowest, because they'll give you the best rate.
Right. And then, that was the one thing. So I said, okay, that makes sense. If you listen to a guy named Dave Ramsey, he always says,
right.
Hey, if you want more quality business, you raise your price and you get rid of, the people that are dragging you down. And, if you get too busy, you raise your price. And if they still want to work with you, you're going to make more doing less anyway, because your prices are higher.
Right.
So that was one concept that they're using. The banks are saying, okay, screw it. You guys want to keep sending to us? We went from FHA at 3% to the same deal 5 days later at 4 1/8.
I know. That's insanity.
That's straight rate.
Yeah. Yeah.
And so that was one deal. And so then the other deal he said, George, well, listen, we already have a pipeline of loans because we've been so busy. So if we drop now the pipeline we have, these people are going to leave us and go to the neighbor where the rate's cheaper already.
Right.
So that's why we had to say, no, we're going to close out what we got first, and by slowing down the incoming, raising the price, then we won't care if some leave because we closed most of them already. Because I even have the ones that are ready to close on my end right now calling me every day. I keep hearing they're going lower. I go, no, listen, you lucked out. We locked when we did.
Right.
So you can go ahead and check with any other bank you want, but your deal is not available to you no more. So you're lucky you locked in when we did, or else you wouldn't be wanting to close right now either.
See,
you know what I mean?
Right. No, I know exactly what you mean. I think you being on the front lines, this is exactly what I've been talking to the people listening to the show today. This is exactly, and now to hear it directly from a loan officer who's talking to both the banks as well as their customers, saying the exact same thing. That's what's happening out there. It's what's happening.
Yep. Yeah, and they could, thank God, I've been, like you said, doing this a long time, and most of these clients are repeat clients, so they call me, and talk to me, and instead of going behind my back and trying to do whatever, or if they do, they do, but at least I'm telling them the truth, and they're going to hear it again from everybody else as they call other people. They're going to hear the same thing.
Hey, let me ask you a question. Let's say I'm a W-2 employee, and I've got a paycheck coming in each and every 2 weeks, but all of a sudden my employer, because of the coronavirus, is got to lay me off for a while. How does that affect when you're doing the income calculation, since this is not really a fault of the borrower? And if there's a gap in his income because of the coronavirus, company had to lay him off, and maybe his credit score got dinged too because now he can't pay his bills like he was. This is something that's way beyond the borrower's control. But how is this going to affect him, and how are we going to deal with it? Because there's going to be a lot of borrowers like this.
Well, that's a great question, and
Right.
I hate to even think about it, but we haven't seen that part yet. You know how it rolls downhill.
Right.
So
Right.
It's starting right now, and thank God, like I said, it hasn't happened to me yet. Where all I'm getting right now from all of our banks is that they're walking in person, and they're closing down. They can do everything online still, and they're gonna have the staff working from home and stuff like that to keep stuff moving. And I've seen where they said even some docs that need to be notarized in person, they're also gonna they'll also let those slide by fax, or normally they wouldn't do it by email.
Right.
Right. Dry signatures, not wet signatures. But no, that's a good question, Jeff, because again, that's coming. It's coming. That's it. I was talking to Steve and my processor about that. I'm like, make sure you order the VOEs up front right now on my new purchases, that we're getting, or whatever we're doing, any new files, and let's find out what kind of business they're in and see if it's going to directly be affected by, this stupid virus.
Right. No, I agree, and I think because it's to be determined, it's hard to give your clients the advice that they're going to need if they're in that position, and if they want to buy a house, or let's say they're in escrow. And they're supposed to close in 30 days, but they get laid off at the end of March. Now what?
Right. And that's something that's unforeseen because we've never been.
Right.
We don't know how this is going to end up, how it's going. It's like every day it's getting worse and worse. Lockdown after lockdown, restaurants now and bars and.
Yeah, you think about that. All the people that we use that really are great borrowers, they're hard workers, but their businesses are closed because the government told them to close it.
Right, exactly. That's exactly where we're at right now. And
right.
I'm just trying to close the little pipeline that I have, just to make these people say, okay, I think our business is going to be on hold right now, on standstill, because of what you just said right now. As soon as the banks get up to par and say, well, they're probably already having meetings about, hey, we better start checking that these people will still work because we're going to loan them.
That's right.
They got to make their payment.
Right, exactly right. Hey, George, we're up against it. I appreciate you coming on again and giving us some insight as to what's going on and some of the reasons behind it. Appreciate it.
Hey, no problem, Jeff. Thank you for having me.
Thank you very much. That's George Gonzalez from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, your voice in the mortgage industry. Thank you for listening to the show. Listen to us on great voice podcasts on Apple Podcasts, Google Music Play, wherever fine podcasts are heard. And they're heard all over the internet and all over your phone. So don't be shy about searching for us. We're everywhere. If you do get to us on one of these fine podcasts, leave us a review. It helps a lot of people. The more people that listen to the show and act like they're listening, i.e. give us a review, the more people can find it because we get pushed up in Google Music search, not music search, but the Google Podcast search engines, and so that's a good thing. We're also on YouTube. Click on YouTube and check into Jeff Barton at The Mortgage Voice, or Jeff Barton The Mortgage Voice. Subscribe to the channel. Click on the bell to get notified whenever a new episode is available, and there's one available at least once a week. Check us out on our website, www.mortgagevoice.com. Again, I'm Jeff Barton. Thanks for tuning in. We're on several radio stations here in Southern California, in the Inland Empire, I just talked to our agent who is out there in Napa Valley, and he said that things are busy out there. What do you see?
Oh, Napa Valley has always been a smoldering pot of money.
Yeah, absolutely.
Because of the wineries and...
Right, exactly. How is you? And Daryl here is one of the owners of the affiliate out there. How is it going out there?
Things are good, Good? I mean, people are wary, obviously.
Yeah.
But right now, the market is down. right? So, I mean, people are expecting if they get in now,
Stock
or get
market, right.
low interest rate now. I mean, on television today, they said the interest rate was virtually zero, is the way they're describing it.
Right.
That, now's the time. And
Well,
if we were to ride the way back up.
The interest rate itself, and there are many interest rate, quote unquote, out there in the marketplace. When you pay your mortgage, that's one interest rate. It's driven by factors. The Fed interest rate, which is what is zero currently, refers to short-term lending from the Federal Reserve to cash-strapped banks in order to cover their needs on a short-term basis. That usually translates into lower interest rates for your credit card. But I got a question. Did you receive any notification from your credit cards that they're going to go from 25% down to 20%?
Absolutely not.
Absolutely not. So a lot of this stuff that affects the member banks is good for big investors. A lot like the stock market. Let's face it. There are many people who watch the stock market and feel good when it goes up and bad when it goes down. But really, less than half of the country is invested. And if you take out people that are invested through their 401ks or through some other investment portfolio that they're in a group or some kind of retirement, you're talking less than 25% of individuals who are in the marketplace. Now, granted, I feel good when the market goes up, feel bad when it goes down, but am I really invested? No, I'm not. Does it really affect the mortgage, the supply of money for mortgages? No, it does not. What affects all of these things are different instruments that people do buy and sell, but it's not the stock market. It would be more bonds or treasury bonds or mortgage-backed securities. These are the type of instruments that are developed by the Treasury and developed by the Fed, but not necessarily the stock market. So I understand the need to want to know that kind of financial information, but for the sake of our show and what we do each and every week is try to bring you information about what's happening to the rates, what's happening to the availability of funds. Now, we're going to have on the show today, or have had on the show today, I'm sorry. We had Luke, who was on the show, Wendy from Stearns, and George Gonzalez, all talking to the points of, where's the money coming from? We certainly know the demand is there. Most people who are looking for a home or wanting to buy a home or wanting to refi are doing it now. Why? Because the mortgage interest rates are so good that you really can't say, oh, I'm going to do it tomorrow. And because fear, it's a funny thing how fear feeds off itself. Back in 07 and 08, it was a terrible time because we saw something that happened that hadn't happened before in our lifetime, right? Obviously, it had happened in the 30s, but I wasn't around in the 30s, and that was, close to, 80, 90 years ago? Yeah, about 85, 86 years ago was when the Depression happened in late 29. So not being around during that time and in 08, when we had the market crash here and the financial crisis at that time, people were afraid, and they were afraid for real reasons. They were afraid because mortgage-backed securities, because mortgages themselves, because the financial institutions that they relied upon failed. And they failed mainly because of faults of their own. Well, in this case, today, what we have is fear in the marketplace, but it has nothing to do with any of the financial institutions. It has to do with a pandemic which has affected the markets because of the nature of how it is unrelenting, and it does not discriminate between rich, between poor, between working, between not working. It cuts across all industries, and it cuts across all economic, socio-statuses. So if you're out there, you want that mortgage, you're still afraid of what's happening with the coronavirus, and I absolutely can. Oh, thank you very much. I just got a note. This is real time. We got a note in from Tyler that's watching us on YouTube. Awesome content, bro. Well, thank you very much. That's very nice. And we do get comments just the opposite, which we're never going to share with you. We're just going to share the nice comments. So thank you very much, Tyler. I do appreciate your listening to the show each and every week. as we're talking about the coronavirus and how it affects your mortgage and how it affects the availability of funds and the psychology in the marketplace of fear and how fear drives certain elements within the economy. In this particular instance, the fear is not about, what's happening at the banks. It's about, what's happening with my neighbor and what's happening with the guy I just spoke to, and is that person infected? Because this is an invisible thing that's going on that we cannot see. It's not as if you can point to the mortgage brokers. Oh yeah, those are the people that ruined the economy in 2008 because they were, despicable people who were giving bad loans, or the Wall Street crowd who was, selling mortgage-backed securities, or the people who were valuing the bonds who didn't even look at what they were selling back and forth. A lot of fingers easily pointed, and this time you cannot do that. So the fear that's driving the marketplace can be replaced with the optimism of, this is a terrific mortgage interest rate. I'm fine. I'm working. I've been guaranteed time off if I need to by my employer, but I still get a paycheck. It's a great time to refi. Take money out of your house, refinance it into a lower rate, maybe pay a little bit more or about the same amount that you can today, tomorrow, but put 30, 40 grand in your bank account in case something even worse happens, where you have to be out of work for longer and they suspend your monthly payment or they suspend your weekly paycheck. Because those things are all possible, and that's what the fear is. But I think because of the interest rates and because what we said earlier in the show, we're going to see interest rates go up, go down, go up, go down, based on the amount of capacity in the system. The banks themselves are going to regulate that by upping the interest rate, i.e. slowing down the spigot, slowing down the waterfall of loans coming in the door. It's not going to be the mortgage bonds, treasury bonds rather. That's not going to drive it. As we've said earlier in the show, it does not drive currently because we've seen the bonds be unbelievably low priced. I think it was 0.34 last week. It was 0.84 this week, and it should remain pretty much the same in terms of the mortgage interest rate, but the mortgage interest rates went up a point, and that's because the banks themselves are trying to slow down the amount of loans coming in. But that particular aspect is going to go up and down over the next 90 days, I'd say. Because I think in 90 days what we're going to see is a lot of the ebbing of the seriousness of the worst part of the coronavirus. And what I think the president did say was the economy will come roaring back. I think there'll be huge pent-up demand as well. But getting in on those low interest rates now is a great idea, and putting some money away for the rainy day that may come. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.